there are some limitations of the financial statements. And so we're going to go through those now. The first ones we'll look at are for the statement of profit or loss. This has some overlap with the statement of financial position as well, though. So the first one, results vary depending on the systems that the business uses. So when it comes to things like inventory values, like the cost of goods sold and inventory adjustment, those figures vary according to the system and the valuation techniques that the business uses. So this sort of inconsistency can be a limitation. Typically, businesses are going to use the lower of cost and net realizable value framework to value their inventories. And this can produce lower inventory records and show smaller profit figures than a more consistent valuation method. So that can be a limitation. It's also pretty complex to calculate cost and net realizable value. So this can then cause discrepancies. Cost can be construed in a few different ways. You've got the first in, first out, or FIFO, or FIFO. You've got the weighted average cost, specific identifiable cost, or standard cost. You may not be familiar with those last two, but hopefully the first two are familiar. And each of these ways of calculating costs is going to generate different figures for inventory, cost of goods sold, and profit. So this can be a limitation in terms of being able to compare with other businesses, being able to understand what this business actually is showing. So it can really vary depending on the systems that they use. Another sort of calculation issue is that there is a need to actually estimate some figures. So, for example, depreciation, you need to estimate the life of an asset and the residual value, and that can impact the accuracy and consistency of depreciation figures that are listed in the statement. And there's also different depreciation methods as well, and they can yield those really different depreciation figures depending on what the business does use. And businesses also have to do other estimation as well. So we were talking about doubtful debts. They have to estimate what they expect to not receive from their accounts receivables. And then this has flow-on impacts. So the quantity of bad and doubtful debts expense that's recorded in the statement of profit or loss, and then that again has a flow-on to the overall profit figure as well. Some other ones. Now, price changes. So the value of money changes over time. So the purchasing power of money, and that results in different periods not being able to be compared. So, for example, if we think of the impact of COVID-19, it would be pretty tricky for businesses to be comparing 2019 to 2020 because of the impact of COVID on the economy. It would also be tricky to compare from, say, 15 years ago when there was like the global financial crisis in that period, and comparing that to a later period where the economy is more stable. That is difficult to do because of those differences in that purchasing power of money and the situation that the economy is in. So inflation, which you probably know about from the cost of living crisis recently, causes the present day profit of, say, 10 million to not be equal to the 10 million profit from 10 years ago. Add it, you know what I'm talking about, revolves around current revenues, current costs, so things like wages, and out-of-date costs being intermixed. And so again, that idea of different things from different periods being mixed together, and those things may not really be comparable because they're from those different periods. And then finally, possible manipulation. So a business can manipulate its financial management practices to cause the statements to be inaccurate in some way, to misrepresent the actual performance. So if you think of companies where managers may earn more money based on the performance of the business, they may be inclined to then misrepresent how well the business has done to try and get extra benefits and bonuses because of this supposed strong performance. So there is that room for manipulation there. In terms of the statement of financial position, you've got some of the same limitations again. So price changes again, estimated figures that you'll need for that statement as well. There are a few other limitations. So a common misconception around the statement of financial position is that it signals the value of a business and its net assets. So it's not as straightforward as that, because assets are typically listed, like we spoke about earlier, at historical cost rather than their current selling value. So for example, if you purchased a building 10 years ago, then it is listed at that price that you paid for it all that time ago. But with the property market, it's probably gone up in value, but that is not reflected on the statement necessarily. So for anyone who's hoping to use the statement as a value statement, it's actually got limited usefulness in terms of that. Now, the guidelines for handling intangible assets are inconsistent. So the intangible assets figure in the statement of financial position is not necessarily representative of the asset's actual value to the business. So, for example, goodwill is not necessarily recorded. It may be recorded if it has a definitive cost, so what it's actually worth, but oftentimes it's not recorded at all. And similarly, things like trademarks, they are often not included, even though they are part of the business's assets. And then the accuracy and usefulness can be limited by things, just small quantities of consumable items being omitted from the statement. So stationery, stamps, fuel, those things can all add up to be to have some value, but they're often not going to be included in these statements because they're more minor than other things. And this follows this idea of those items would be written off as expenses. So that's why they wouldn't be included, because stationery is just one of those things that you've got to pay for some basic things, and it's not really seen as an asset.